Hey guys, Bob Vieira, Universal Short Sales. Welcome to the weekly wrap up distressed real estate news. This is where we're going to talk about the two major topics that I pulled from this week's news, specifically pertaining to distressed real estate markets. Okay, because after all, as real estate investors, real estate agents out there, it's very crucial to understand what's happening in not just the real estate markets, but the distressed real estate markets. So I'll try to hop on here. I'm going to try to do this once a week for maybe 30 to 60 days, and we'll see how it goes. We'll see how you guys like it. Now, I'm pulling these topics, these two topics, from a newsletter that I send out every Friday morning. If you're not signed up, you're definitely going to want to sign up to it. It gets really good response rates, very good open rates, and awesome feedback. Investors and agents find it very, very helpful. So like I said, if you're not on it, sign up to that ASAP. All right, topic number one is the top 5 metros with the highest foreclosure rates in the month of August. So ATOM Data Solutions, or ATOM, however you pronounce it, not sure. Very, very large, very popular real estate data solutions provider, just came out with their foreclosure report for the month of August. So on a national scale, okay, completed foreclosures rose at around 28% month on month. That's a huge number. I'm going to get into it a little bit later, why that shouldn't scare you quite yet, but it's definitely something that, we want to pay attention to. I mean, 28% is a very large number month over month. So taking a look at the local level, the top 5 metros, because really, guys, paying attention to the national scale as far as the real estate cycle is concerned is important, but it's not as crucial as paying attention and understanding what's happening on the local level. All right, so the 5 metro areas, number 1 is Cleveland, Ohio, where about 1 in every 1,800 units has a foreclosure filing. When I say foreclosure filing, keep in mind that means a lis pendens. So really, that doesn't even count the people that aren't in pre-foreclosure yet, and they're maybe 30 to 60 days behind on their mortgage and the bank hasn't filed the lis pendens yet. Okay, so it's 1 in every 1,800, but the actual amount of people that are behind on their mortgage can be much more than that. It's very possible. So that's Cleveland at number 1. Number 2, they have Chicago, Illinois at about 1 in every 1,800 as well. Number 3, Jacksonville, Florida, about 1 in every 2,000. Number 4, which does not surprise me, is Riverside, California. Riverside, I always see them come up when it comes to, a high number of pre-foreclosures, a volume of REO properties, short sales. They have a lot of underwater properties. So I'm definitely not surprised about Chicago, because they're actually, when it comes to pre-foreclosure volume in the nation, Cook County is number 1 by far. Right now, as we speak, they have like 8,000 plus active pre-foreclosures. And then, like I said, Riverside, California doesn't surprise me. Number 5, Orlando, Florida at around 2,400. So here's what I'll say. This is my take about, the foreclosure rates here. As I said before, 28% month over month is a big number, but let's not get carried away. Keep in mind, banks, because of the government intervention and the moratoriums, they haven't been able to foreclose on people for the last 2.5 years. Obviously, there were some foreclosures, but the vast majority of foreclosures were completely halted and paused. So, they have a backlog of pre-foreclosures that are just starting to hit the market now. Okay, banks are taking these backlogs, especially in the judicial states, where they have to take people through the court process. Banks are pretty much rushing to get this bad debt essentially off their books. Because of that, you're going to see these pre-foreclosure rates rise and rise and rise. But because they were historically low, okay, because the US had a historically low pre-foreclosure rate because of the moratoriums, you're going to see these huge jump in numbers. Don't get freaked out yet. Again, pay attention to it. Focus on your local market, but in my opinion, it's not that big of a deal yet. All right, let's move on to the headline number 2. which is from Housing Canary Incorporated. All right. They did their own little housing market report themselves. And, the overall gist of the report, I'll give you the cliff notes on it. They think the market going into the fall and then into the winter months is going to slow down, and it looks really grim in their report. Doesn't look good. Very, very negative. They like to blame it on a decreasing buyer demand partnered with a lot of price drops. So less people wanting to buy properties, partnered with, a lot of those really, really insane listing prices starting to come down. They think it's going to get worse and it's going to snowball into the fall and winter months. I tend to agree with them to a point, but to be honest, I'm not completely sold on the narrative that the market is crashing. Okay, in my opinion, is it starting to slow down? Are a lot of these markets starting to come back to reality? Absolutely. But a lot of the YouTubers out there and the people trying to get clicks, they're screaming that the market is crashing, everything's in free fall, freak out. I totally disagree with that. Okay, you have to remember, a lot of these sellers were selling their property because they realized how insane this market is. So they were listing at very, very high prices, which is what I like to call wish pricing. So the property's actually worth, let's say, $300,000, but the seller knows it's an insane market. So they list it at 450, 100K above. A lot of the price reductions you're seeing are a lot of those wish pricing people. They're starting to come way, 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 way down back to reality. Just because they're coming back down to reality does not mean the market is in free fall. It doesn't mean the market is crashing. It just means that it's coming back to normal. A lot of these markets where you're seeing major price reductions, if you look deeper into the markets, it's still a seller's market. You still have very low inventory, historically low inventory still. So while I agree with this article that, a lot of the buyers are starting to pull back a little bit, and the demand is definitely waning a bit, there's still historically low demand. Or, I'm sorry, there's still historically low supply. So the inventory levels still has a very, very long way to catch up. That's why I wouldn't freak out yet. The market's starting to slow, but I think we're a couple years away from an actual crash. So those are the two topics, guys. I hope that little insight helped, and we'll see you on the next one.